Joel has been wearing the same sweater for a month
It's
now.
gross, dude.
It's time to go digging for value. I'm Allison Southwick, and I am joined as always by Taylor Muckerman and Joel South, energy analysts here at the Motley Fool. Today we're going to look at the headlines, and then we're going to cover some earnings, do a little Goldilocks, too hot, too cold, just right. Let's get into the headlines.
All right, what are we waiting for?
Nothing. Let's do this. We're going to head to The Economist, where they are taking a deeper look at tight oil production in an article entitled Saudi America. They're painting a really rosy picture of job production and generally the global energy stability that this could offer. Also supports lifting the ban on crude exports, and also very cute, every photo has the caption of, like, it's something like fracking the Bakken, which I thought was cute.
Yeah, that's what The Economist does. Very cheeky.
Cute.
Saudi America.
And it's also very interesting when you look at all the charts, they're all hockey sticks. You're seeing some production then just soar up. And that's really what you're seeing with a lot of the tight oil production. And, you know, these are fields that we've known oil was there. We just couldn't get at it economically. So you're seeing horizontal drilling and fracking take advantage here. And, you know, what they're looking at is, will the United States overtake Saudi Arabia as the biggest oil producer in the world? So they're looking at 2020 maybe producing more than that 11.4 million barrels per day. And, you know, the picture they're painting, it looks likely. The jobs that you're talking about are looking close to 2 million jobs that could be added from this boom. So there's a lot of excitement in this piece.
So one of the things they talk about is whether or not the U.S. could actually start dictating oil prices like we did back in the good old days.
Yeah,
so what do you think? Is that a possibility?
So yeah, what they're talking about is, are we that swing producer where we can fill in the gap if there's a shortage in oil or if demand suddenly increases? And, you know, there's a lot of, the article makes a good point for it, but they're missing a couple points. You know, when you start drilling these wells, it takes about 90 days to actually get oil from them, and the decline rates are so much faster, so you're not building on an incremental base. You have to keep drilling to keep the production stable. And at the rates right now, if you were to go out to the Bakken, just to keep the rates steady, you have to drill about 2,500 wells a year. So, you know, that you have to take that into effect. And you also have to look at the people going and drilling. Usually these price spikes are short-term in nature. Companies aren't going to take advantage of a price spike and throw out a lot of money in case it reverts back to where it was. So a good example is looking at natural gas so far this year in 2014. Prices are up significantly. They went up to about $5.50 from the mid-3 levels. And do you see more people going out and drilling? Not necessarily, because they know this is short-term in nature. So I don't think we will be that swing producer state, but we will be potentially moving towards that 11 million barrels per day. We could be a huge producer, but not dictating the prices.
All right, we're going to move on now to Bloomberg, where we got, according to the consultants at EY, China is closing in on the U.S. when it comes to renewable energy. China scored a 73.1, which means nothing unless I tell you that the U.S. scored a 74.4 out of 100 in the Renewable Energy Country Attractiveness Index.
We are sexier than China.
Rawr.
I'm just going to throw that out there.
Right. So what was your initial reaction, aside from the fact that that is a really catchy title?
Well, the headline of the article, I think, kind of misses the mark in my mind, because all the talk about China, what we want them to increase their greenhouse efficiency and limit their exposure to greenhouse gases. And we've also kind of come down on them for building out so many new coal plants. But yet this article is kind of denouncing the fact that they're catching up to us. I think it should be that the U.S. missed the mark, because we actually slipped back a little bit in this rankings. We're still first, and we have been for several years. But I think it's a good thing that China's catching up to us.
So why is China gaining on us, aside from us slipping a little bit? What's going on? What's at play here?
Well, you're seeing them just throw all kinds of resources at solar power and wind power. You look at them putting into place 12 gigawatts of solar energy and photovoltaic energy in the year of 2013, and that's more than the United States has total installed, and so they've just automatically right there leaps and bounds beyond us. And then we took a huge step back in wind power. We only installed 92% less than we did in 2012, because you saw a lot of tax credits come off the table. So not only are they gaining on us in solar, but we're pulling back in wind. Although you wouldn't necessarily see that if you look at a company like GE's earnings report, because they said that they have a 63% higher U.S. demand for wind orders in the fourth quarter of 2013. So maybe that's going to pick up here with those orders coming in later in the year. But in 2013, China really trounced us.
All right, let's head over to Oil and Gas Financial Journal, where a Douglas Westwood analyst says that the days of easy oil are over. Majors like BP, Exxon, and Shell have peaked, and according to this guy, Middle Eastern national oil companies may also have peaked.
Yep.
Now, before we head to the Middle East and talk about the national oil companies, let's talk about the peak for the majors first. What's been going on there?
Yeah, so what we're talking about mainly is cheap oil. So that's conventional wells where you basically plug in your straw, drink the milkshake. You're basically on a huge reservoir of oil where, yeah, that too, where the unconventional drilling is more expensive to do, so the days of cheap oil. And you're starting to see that. If you look at ExxonMobil, they just came out with their reserve replacement ratio. It just how much they drilled and how much reserves they replaced on top of that. It came in at 103%. You like to see it over 100%, but that's significantly below their average. You're also seeing companies like Shell, Royal Dutch Shell, they've basically moving away from oil, and they're going more into offshore, and they're also looking heavily in natural gas, and they want to move to produce more than 50% of their production in natural gas. So they're kind of moving that way. Then you're also seeing other big majors like Total going into renewable space. So you're seeing cheap oil being taken away from these companies, so they're trying to find reserves into other resources.
So what about the national oil companies? The Middle East, he talks about here, is also peaking potentially.
I think that's the biggest part of this story is traditionally nationalized oil companies, we're controlling a lot of the cheap oil. You saw a lot of the international oil companies kind of move away or kicked out of countries, and that's why they're moving to other resources. But with NOCs, if they start losing their cheap oil and their aging fields are coming about, then basically you're going to be looking at deep offshore drilling, and you're going to look at a lot of shell plays to produce your oil. So, with those costs, you're looking at the end of cheap oil. You're looking at prices that aren't going to drop down to that $60, $70 per barrel unless it's a quick drop in price. But for the long term, you're looking at expensive oil. And if you look at Kuwait, Qatar, Saudi Arabia, and United Arab Emirates, from 2000 to 2013, the study also looked at their production grew by 33%, but their well count improved or increased by 109%. So you're seeing so much more drilling for less oil. Not a good sign for cheap oil prices.
All right, we're going to stick around Oil and Gas Financial Journal, solid outlet here, where we are hearing that the shale revolution is only the first inning of a 9-inning game, and that's according to the chairman and CEO of ConocoPhillips, man with two first names, Ryan Lance. So the current production levels, we're getting 235 years supply of natural gas.
Yep.
He says that's a big underestimate.
Yeah, especially because that doesn't include the Middle Eastern estimate, so that's probably going to maybe double that 235 years that we're talking about. And then you get to more technological advancements, probably increase that duration as well. And this is pretty impressive coming from the #1 oil and gas independent producer in the United States. And then you also see what he means by first inning, in my mind, is that the U.S. is really the only country that's really started to take advantage of this on a full-fledged scale. So much so that EOG Resources in their conference call they just had, their CEO talked about them not seeing the oversupply of natural gas coming offline until 2017 or 2018. So they're completely removing focus from dry natural gas for the next few years and just looking strictly at oil and natural gas liquids.
So the point that the CEO makes is that advances in technology are what's really going to blow us away in the coming 8 innings. What companies do you think are driving technology in the shale revolution?
Yeah, that's definitely the ticket. This wasn't possible without the technological advancements of horizontal drilling, fracking, and the likes. And then you see people using less water in their wells, which is also helping in the United States, which will be even more imperative abroad, where water scarcity is a much more serious issue, especially in China, where most of the wells are far away from fresh water sources that these companies are looking for. So using saline water or frack flowback is definitely going to be imperative. And Halliburton and Schlumberger are leading the way here with their technology that they've been pioneering. And the thing I like about these companies, Schlumberger in particular, international exposure. They've got a great reputation abroad. They have facilities set up in some of the biggest countries on the shale scale around the world, and Halliburton's catching up. So these two companies, with their history and their global footprint, I think they've got a great advantage.
All right, guys, well, that's going to do it for the headlines. Now it's time to take a look at some earnings that have recently come out, and we're going to take a look at it from a Goldilocks perspective. We've got 3 companies, EOG Resources, Seadrill, and Solar City we're going to talk about. I want you to tell me if the market reaction was too hot, too cold, or just right.
Okay.
All right. All right. So the first one we're going to look at EOG Resources. They're up about maybe 3.5% right about now before I came up here. After beating analyst expectations for the fourth quarter, total revenue for the year was up 24% over 2012. Joel, what did you think?
What's the signal for just right?
Oh, I don't know. Do we have a signal?
Do we have a signal?
Just eat
the porridge.
Yeah.
I think it's just right. I mean, this is a company that is known to always beat analyst estimates. I mean, you can look back almost, I mean, it's been years since they've actually not beat estimates. And, you know, they're all about oil, which you talked about earlier. This is an oil company. They grew in 2013, their oil production by 40%. And, you know, now they're starting to command or get free cash flow. They're starting to compete on that dividend. They increased their dividend at the highest rate they ever have, 33% jump. They are still pretty expensive, but they keep growing so much. And what I really like about the company, the Gonzales and DeWitt County and the Eagle Ford, basically they have big positions down there. It has the lowest break-even cost for oil. They really command that. And then they're also growing in the Permian and the Bakken. They have their transportation to command higher prices. So, you know, I really like this company. 3.5% I think is about right off a quarterly estimate. I don't think they're really going anywhere, but I would be kind of shocked if it soared, you know, 10% after an earnings release.
How about you, Taylor?
I think it might be a little bit too cold. I think that the fact that, yeah, the dividend is great, 33%. The company has just started paying it very recently, so to see them have the confidence to increase that, and then looking at 27% growth next year or this year as well, they've got a great near-term future. But the long-term future was improved because they boosted Eagle Ford recoverable estimates by 45%, so that hits right on the nail with Joel's talking about the counties with low production costs. And if they just can increase their reserve base by that much, 45%, you know, cash flow could just keep rolling in.
All right, next up is Seadrill. It took its biggest hit in 2.5 years today after announcing that rig market growth would be slower than expected. They also postponed their dividend. What did you think of the results?
You know, I'm going to go with a little bit cold. I think it should have done a little bit worse. And the reason is...
the worst drop in 2.5 years.
Well, the reason is this company is growing their business by using debt. And they increased their dividend once again. And they also looked for next year. They're looking and actually pinpointing some of the softness in the rig market. Their ultra day rates were down from the previous quarter. You know, all this spells is that increased dividend, EBITDA kind of dropping. It really scares me because they're already such a levered company. You know, the shortness is only supposed to be 1 year, so they can easily fight through that. But you know, I think if you're a company that's really playing with debt and you're not sure about the future, they do have good backlogs. But you know, capital spending for a lot of big oil companies they're still going through that process. Yeah, if they were to lose some contracts, I think this could really hurt them. So, you know, I think the 5% obviously does hurt. It's a big drop, but it could have been more since they are such a levered company.
I have to agree. It definitely could have been more. That this company is bought for its dividend, and to see some possible weakness here. They talk about increasing it this quarter, but they're shelving any increases for the foreseeable future. And that's what investors bought into this company for, because it's a double-digit yield. And like Joel mentioned, the leverage is astronomical here compared to other peers like an Ensco or a Transocean, even though Transocean kind of sits right in the middle of those two. Seadrill went out and they were binging on new rigs. They don't have any more orders coming through that they're planning on putting into the shipyards, but that was their lifeline, and now to see them completely almost revert course is a little dangerous for investors.
Yeah, all right. Last one, we're going to look at Solar City, the biggest name in residential solar here in the U.S. took a hit today after releasing, we'll call it partial earnings, because they postponed full financial results until March 3. But still, they took a hit today.
They took a hit, but then they got it all back plus some. They were up pretty significantly. So I don't think, you know, I don't know if I'm hot or cold because I don't think the market really knows right now. You know, what I'm looking at is they met their guidance. They increased revenues by 87%. I think the biggest takeaway here that people need to look at is when you're looking at their revenue, there was a lot of people actually going out and buying the panels, not leasing them. They have higher margins when you lease, so you like to see that leasing number a little bit higher. However, they still did very well. Their installation is supposed to be down slightly next quarter due to weather. That will bounce back. So, you know, long term, this company is still pretty solid. They're still looking for that 1 million installations by the middle of 2017, beginning of 2018. So I still think they're solid. However, this earnings release, we'll see, I guess, next week. But I'm just not sure if it's hot or cold yet.
Yeah.
I thought it was cold aftermarket when the investors kind of sold off. And I think some smart money got in there and opened the market around 3 to 4% higher because they did have such a great fourth quarter and really the whole year of 2013. They had 4 specific things that they really wanted to target. They wanted to deploy 250 megawatts. They deployed 278. They wanted to reduce cost per megawatt. That's down 30%. They wanted to reduce their cost of capital. They did that through very unique securitization deals. And they wanted to have positive cash flow by the fourth quarter. Check. So they hit on all 4. They're looking to increase deployment by 71 to 89% in 2014. I'm sure that range will tighten as the year goes along. But I mean, to see this company down, I think some people got a little confused when they saw first quarter guidance a little bit lower than the fourth quarter. But the seasonality comes into play there, and some people might have gotten worried about them delaying their earnings.
Yeah.
But that's just for them to work out some late season mergers and acquisitions that they had. So I think all is good and well.
All right, well, we can check back in on March 3 then.
That's right.
All right.
You know we will.
And we will.
We have to.
All right, that's going to cover it for today. If you're looking for more energy investing analysis, you can follow us on Twitter at TMF Energy. And if you have a question for us, we haven't done a mailbag segment in a while, so send us your questions.
We should have one, yeah.
To energy@fool.com. That's it for today. For Taylor and Joel, I'm Allison. Thanks for watching.